Good morning, Market Chameleons. And there he is right away, Dimitri Pargamonic. How are you doing, D?
Good morning, Will. How are you?
Awesome. You want to start with the disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Yeah. A couple housekeeping notes tomorrow. Dimitri and I both have personal items we have to take care of, so we're not going to be having the morning show. Also, yesterday it got a little heated on the chat, so I'm going to, and listen, we've done over 1,000 shows. It's a pretty personal live show with users of the Market Chameleon, people who do pop in. But if there's any negative energy coming from the chats, I'm immediately going to drop individual, which is a bummer because everyone can bring interesting stuff. So bring your interesting comments. Just leave the negative chats to to Twitter and other spaces, not here, please.
Yeah, and I think what you mean by negative is that you don't want to be disrespectful to other people or name calling or like that. It's okay to disagree on things and bring different viewpoints. That's the point. Not everybody's going to agree on the same thing every time, but you just don't want to do it in a mean way. And I think part of it is people also feel there's a lot of volatility in the market, and then with a lot of volatility there are shakeouts. Even things become irrational. There's a dislocation of risk assets. Things are moving around. They're not going to make sense. Things are getting repriced really hard. But you just don't want to, and I think for the most part, we haven't never even had that situation. So I didn't see it.
We've done over 1,000 shows. Yesterday was the first time I put people in a timeout.
And we really appreciate, everybody here, we really appreciate people come on the show and talk and contribute a lot. And, we just don't want, name calling and stuff like that. Then there's no point in that. So having said that, I think what we'll do today is we are open for questions. If you guys have any questions, put those in that live chat. Will's watching them. He'll read them back to me. It could be Market Chameleon tools, data, analytics, statistics, strategies that you're seeing out there you want to discuss, or you want to come on a show and discuss and talk about your point of view, or you want to talk about, strategies that you've been doing, things that you've been seeing that are working out for you, or something you discovered. You're welcome to come on a show and share it. That would be great. If you want, you could come on a show live, right? We put out a link there to Zoom. You could click on that link. It takes you over to Zoom. Just once you get to Zoom, click raise your hand. When you raise your hand, that will, you don't have to turn on your video camera, but that will allow you to talk to us live. You could ask your question like that directly. Okay.
Perfect. Yep.
So what we'll do today is, I think, we'll start out with the pre-market report while we're waiting for any questions to come in. Discuss what's moving in pre-market hours. Maybe we'll talk a little about the markets or where they might be going, how they might get repriced. So I'm not going to get into like a really deep, model or analysis, but just kind of discuss things like where we could be looking at, where do we think things might get repriced to. And we have some examples during Fed tightenings that happened during the internet bubble. It happened, when the Fed wanted to pop it, take out the froth. There was too much enthusiasm in those markets. They don't want these bubbles they needed to pop them. Happened during the housing.
And that was a completely surprise announcement, wasn't it?
What?
During the internet bubble. It wasn't telegraphed at all, was it? my
They were
recollection.
raising interest. Yeah, no, they were raising. You don't remember the famous speech by Alan Greenspan, "Irrational Exuberance," and so they were trying to
All right,
pop
so
that
they were
bubble.
telegraphing. You're right.
Yeah, they were telegraphing it. 2008, it was already out there. Here we're trying to fight inflation, and the only way the Fed's tools, they can't produce more goods. It's a worse situation what we're, I think, seeing today than probably in those bubbles, because um, those bubbles, you know, here the Fed can't create more supply, right? They can't create more supply of energy. They can't create more. So the only thing they could do right now, their tool, is to create a recession, which puts us in a stagflation, right? If the inflation continues and a recession. So I feel like it might be even a worse scenario here. And we'll see what they do and how they navigate through these waters. But this is definitely a tougher situation than I think before.
And it's an everything bubble, right? We had,
Yeah,
tech stocks, everything was based on price to sales and revenue
right.
growth. We have the housing market. We have the cryptocurrencies that are now embedded in the financial system.
We had so much liquidity that they created the internet bubble. It wasn't even Fed driven. It was
investor driven.
It was investor driven.
Investors are the ones who lost a lot of money, and they changed a lot of laws because of it.
Yeah. And that bubble, they said, was more contained because it didn't spill over to the investors got hurt for sure, right? The people who were buying those stocks, and there were a lot of people in there, but it didn't spill over to other parts of industries and the economy. Housing bubble was a little bit different because that impacted other parts of the economy. Our housing market, it's with mortgages and banks involved and so many businesses tied to the real estate market, that was felt, I think, across the board. They had to come in, do bailouts. Here, I think you're right. Well, we have like everything bubble right now. Housing, cryptos, potentially stock market, potentially in some places. And I think everybody's going to feel this recession if we're not feeling it already. So, but we'll discuss it a little bit more. Let's do the pre-market report. Maybe we'll take a look at some valuations and just to see where we're priced now, what we might potentially get repriced. Perfect. Sound good? Yeah. So here we got this is the pre-market report. These are stocks moving in pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. I see we got 54 stocks that made our percentage gainers list, 153 on the decliners. So from this perspective, we're still looking like bearish buys at the open, so more downside pressure right now. Let's filter out this list to S&P 500 stocks. So we're going to take away any of these low cap stocks, ETFs, leverage products, see what's going on in S&P 500. To do that, I'm going to use this filter in ETF. I'm going to drop it down. I have all these ETFs to select from. By choosing SPY, that's the S&P 500 ETF, I see right now one stock made our percentage gainers list, 37 on the decliners. So that also looks like a more bearish buys at the open. There are no questions yet. Well, what I'll do is take a look at SPY and other risk assets for now, see, how they're valued at this point.
Perfect.
Okay. So when you're any financial model out there that you run will always take into consideration the risk-free rate, right? Because whenever you invest in a risk asset, you want to make X amount over the risk-free rate, because you don't want to make less than the risk-free rate, because there's no point taking a risk. You don't want to, and there's no point to yield exactly what the risk-free rate is, because then there's no point taking the risk either, right? So every financial model that you see, option pricing model, valuations, and stocks, will take into consideration where's the risk-free rate and where you think the risk-free rate is going to be at, maybe 6 months from now, a year, and where is it going to stop? And right now that is being debated, right? Because we've seen some Fed officials say we need to go as high as 3.5% to tame inflation and hold it there. 2.5% is what people really right now are looking at as where the Fed is neutral. They're neither stimulating or contracting, but we're still far away from there. We're at like 3/4 right now. And you could kind of go look at the Fed releases. This is the Federal Reserve, and they show you projections they make. And these projections, they change all the time, right? The next Fed meeting, they're going to probably change, because as they're getting new data in, they're reading new inflation numbers. They're looking at all these to see, they're showing you other things they're looking at to make these Fed fund projections, right? So here they show you for each year, 2022, 2023, 24, in the long run, where do they think the Fed funds risk-free rate is? So this is for each year, right? And they even show you what they were projecting in December. So you could see how much it changed. Look, changed from 0.9 in December. Now it's 1.9, they believe, in 2022. 2023, right? Just in December alone, we're not that far away, right? 5 months, 6 months, 1.6, 2.8. So you could see that this does change as new information is coming in, but it's been trending higher. So far, their projections continue to go higher and higher. And you could see here the long run right now to 2.4%. That's where they think in the long run, they might take it up and then bring it back down a little bit, right? In the long run, 2.4%. Right now we're at 3/4. So what is that telling us is that we're still stimulating, right? Right now, the Fed is still stimulating, which is being felt in our economy, right? We're still feeling economic activity from Fed stimulus that they're going to be removing. And it takes, I don't know, like 6 months for every Fed rate hike. Takes probably like 6 months to hit the economy. So we're still in a stimulus, and I think that our projections are being made off that, and we'll take a look, but I'm not sure if we're fully repricing. Well, what if Fed isn't stimulating? We're in an economy, what sectors, what's going to get, what are going to be the new earnings? What is going to be the new reality if the Fed isn't pumping out easy money? So we could see kind of here as guidance, but from what I'm reading, I think that, that it might be even higher. They might start raising it. It may be as high as 3.5%. Okay. So those numbers have been being thrown out here, and we could follow, what are they looking at? Well, they're looking at GDP. So we could see here their projections in GDP, unemployment rate, in PCE inflation, or PCE inflation. So we could see some of the major economic metrics they're following. So we can follow these in between and get ideas how they might, how these are changing, because we could see what they're projecting and how it might impact their projection on the Fed funds rate. All right. So just wanted to show you guys could go in the Federal Reserve and get this data yourself. All right. But let's use 3.5%, just as maybe a bad case scenario, that we have to go up to 3.5%. And I'm going to come back here, and then I just start looking at some risk assets that, in my opinion, are very sensitive to interest rates. And when we talk about as investments, there could be two things right now going on. There are people who will go into a risk investment because they could yield more, and the yield that they could get above the risk-free rate is worth the risk, right? So it has to be worth your risk. So if you could get 2.5% in a bank, you're not going to make an investment that you think it'll make you 3% in a year, but you have a 50% downside risk. That would be silly.
It's an interesting comment you're going through in discussion. Rob says he thinks there's also a balance sheet in there, and even though they're still stimulating, and correct me if I'm wrong, but they're stimulating because that rate is not lower than the inflation rate, right? In order to bring that rate has, like in economic theory, that rate would be have to be higher than the rate of inflation to actually slow the economy.
Right, exactly. And usually you want to be above the inflation rate a little bit, like you don't want to be too high above it and too low below it. You're stimulating. That would be considered stimulating. Why? Because what's happening is if your savings are earning less than the rate of inflation, your purchasing power is going down, and it's forcing people to go spend their money because every year you don't spend it, your purchasing power, what you could afford in the future, is decreasing. So basically, if you don't spend it today, next year you're going to be able to you're buying less, right? So it's forcing you to go out there and spend the money today. That's why when it's below the inflation rate, it's stimulative because it's forcing people to go and buy, right? Or you're at risk of losing your purchasing power.
I had a friend who helps me with my pool. He told me to go out and buy the Polaris. I forget the name of the motor, but it's like a secondary motor on your pool. And he said, go out and buy it now because it's already up like 20% this year, but he says they're going to double in price, and I'll probably need one in the next couple of years. He just told me to go out and buy it.
Right.
It's a great investment.
They're like, because you might be spending much more later on. And if you're getting interest rates above the rate of inflation, then your purchasing power is increasing, right? Because if you're earning 3.5%, but on average prices went up 2.5%, well, your purchasing power is increasing. So that would be pulling. They would be dampening demand, right? And taming inflation. So right now we're still in the stimulative phase, right? They're trying to bring it up, but they're doing it in stages, because they want to see how the economy absorbs each rate hike. So let's just take a look at maybe some easy examples that we don't have to run a model, right? We don't have to create an Excel spreadsheet and put all these inputs in, given weightings. Let's just take a look at it from this perspective. And I look at a REIT. And a REIT is close to me like a bond, because a REIT, I think it has to pay out 90% of their taxable income as dividends, right? So it's not like a growth stock like Facebook or Tesla or Google. You're buying a property. What's the formula? You buy a property, you rent it out, you collect your rent. After your expenses, you pay out, that's income you pay out as dividends. Hopefully, you could raise your rents, a little bit every year, but it's very close to you're competing with, almost like a bond, a little bit riskier, but like a bond. And right now I'm looking at the dividend yield on this REIT is 2.6%. So this is the S&P Select Sector REIT, 2.6%. And another thing to keep in mind, that also there are carry trades going on. And a carry trade is if you could borrow at a certain rate, right? Let's say you could borrow at 0.5%, and you could take that money and invest it and earn 2.6%. Well, that's also stimulative, right? Because what we're saying is you're doing a carry trade. And real estate is a carry trade, right? You get a mortgage, you you carry the real estate, you earn rent, you pay your mortgage off, and you keep the difference. Hopefully, you're raising rent over time. So there's a carry trade, and then there's competition between what you're getting at the bank and what you could earn in a risk asset. So here at 2.6%, maybe that made sense when interest rates were zero. Maybe it made sense, when if you could borrow, slightly above the Fed funds rate, or 0.5%, 1%. But if we're going to 2.6%, or what was it here? If we're going to these numbers,
we're higher, right? That's also.
Yeah, to me, this doesn't start to make any sense, because why am I holding this REIT and earning the same thing I could just get in the bank, risk at the risk-free rate, with insurance, no risk to capital, right? That becomes, so the only way to get this REIT dividend yield higher, right, is either the income, the rents are going to go up, right, and then the yield will go up, or the price has to come down, right? So if this is not going up, if your income is not going up, if rents are not increasing, if they can't push it high enough, then what you're paying for that investment has to come down, because you're yielding, right, based on what you're paying on your investment. So it's something to consider that, well, what is a reasonable dividend yield if interest rates are at 2.5%, potentially 3.5%, right? So there's that would be a very big repricing if that happens, right? In my opinion, that could be a drastic repricing. And I'm not picking on.
Yeah, and they've already started to reprice it a bit. I mean, this was $50 at the end of April.
It's starting to, because their models are changing slowly. But I'm showing you not to pick on REITs, because this is happening throughout. This is just one, asset class, and I'm seeing this throughout all of them. They're all also relatively priced like this. Let's take a look at another one. Here's a preferred stock, right? So this here is the ETF with preferred stocks. Now, preferred stocks are not like common stocks. It's closer to a note, where the company issues a preferred stock, and they say, we're going to pay you dividend interest, and usually it has like a par value or something. They call it back in, so it's very close to acting like a bond, and you don't have that inflation or upside to the upside. So if we look at that dividend yield on the preferred stocks, right now I'm looking at 4.5%. And remember, this also, preferred stocks really don't, once you buy preferred stock, it's not like a common stock where you make the common stock. If they make more earnings, more income, they could increase the dividend. This is pretty set. You could get like a variable preferred, but this is kind of set. So you're not participating in the growth of the company. You're really just trying to get that dividend yield, but you do have risk, because that preferred, if the company gets in trouble, they might not be able to pay that dividend, right? So you are still taking a risk. It's not the same thing as, a treasury bond. The company's ability to pay that, is at risk. So we're looking at 4.5% right now. Again, maybe that makes sense with interest rates at zero, nothing in the bank. Maybe makes sense also as a carry trade. If you could, if your broker lets you borrow at 1%, you could buy these 4.5%, and you do that carry. But I'm not sure if we get to 3.5% that this will make sense anymore. And again, this will have to get repriced too. And if we're at 3.5%, we're looking at very, very large repricing. At that point, what do people want to earn above that risk-free rate, right? And if you want to earn 3% above the risk-free rate, right? That means if we're at 3.5% and you need to be 3% above that, this would have to go up to what, 6.5%, maybe higher. That means these prices would have to go down, right? And you could do your pen and paper and figure that out, but you could see that the prices will have to come down if that's the new reality, right? And SPY, how would we look at that? So SPY, it does have a dividend yield, right? But in the market, it's not so much the dividend yield because it's not like a REIT or preferred stock. You got growth stocks in there. You have, retained earnings. You have reinvestments in earnings. So it's what at least I like to look at is how much of their earnings that are coming from their normal days of operations. If we added all those up, what is that yield? So let me come down here. This would be the operating yield. So right now we're at 5.5%. In other words, think of it as if I bought at current market value, today's market value, if I bought all the stocks that exist in the S&P 500, that means I would own all these companies, right? Every company in the S&P 500, they would be mine if I had enough money. And that means I get to keep all the earnings that these companies make. So what
is if you're buying the SPY, you're not actually owning the stock. Isn't that correct?
If you're buying, you're not owning the stock, right? So right now, if you're buying the SPY, you're buying an ETF, right, with the rights of the ETF, but you're not actually buying the stocks. But this is just kind of a similar, analysis. If we did buy all of them, right now, the operating profit margin yield is 5.5%. Maybe that makes sense for two reasons. With interest rates at 0, it makes sense, and the earnings are growing, right? So these are growth stocks. So you do have a growth rate in there. Revenues growing, net income growing. So they do grow year over year.
Unless there's a recession potentially, right?
Unless there's a recession. Right? So if you decelerate growth, right? If you decelerate growth and you have, on top of that, if you have contracting margins, like we've seen in Target, Walmart, Amazon from inflation, so that's going to eat into it. And then you have to compete with the risk-free rate, right? Because the carry trade is no longer as good. The risk-free rate is better. If we're at 3.5%, where does this have to be, right? At 3.5%, does this have to be at 7, right? And if it's at 7, is 7 enough? Because what is the new growth? Can the companies continue to grow at the same rates they have been at 0%, right? Because then you have to take that into consideration. How much of that growth is due to stimulus? If you put all those, and I'm just doing pen and paper and stuff, but if you take in that 3.5%, the potential to, this coming down, revenue growth, operating margins shrinking, you could really see a scenario here that we're down 50% from here. That is still scary, right? So I'm saying that would be in a very bad scenario.
Which is a full-blown recession.
Which would be a full-blown recession with inflation, like a stagflation environment that the Fed is having to battle. So we're right up at 9:30. Well, I guess no questions today.
No show tomorrow, everybody. We will see you Monday.
Yep. Monday will continue. Sorry, but we cannot do it tomorrow. We both have something going on very early in the morning.
I mean, the big piece I'm getting from this discussion today, which was really in depth, is you have to be very cognizant of what's going on with the Fed, with rates, what's going on. Like if we keep getting inflation numbers that are significantly higher, they're going to be more compelled to raise those rates and get more of the bonds they're holding off the books.
Yeah, and you can't fight the Fed like all these. We've seen that. It's
Yeah, well, that was on the way up. That was
Fed.
you can't fight the Fed, and now on the way down, the same thing's true, right?
You can't fight the
you can't
Fed.
fight them if they're not stepping in. You better be
Yeah.
comfortable holding longs into a fallen market, or look for bearish opportunities. Like Rob said earlier, there have been some great trades this week, but for long-term investors, buy and holders, it hasn't been a fun week, right? If you're looking,
it hasn't been a fun week,
or if you've been long, you know, you could be trading from the long side. It hasn't been a fun week. We did have one question from a new chameleon, Frederick was asking, and maybe we can get to it Monday, just so you know, do block trades show up in the charts? Last night, there were huge trades after hours, I guess, in Microsoft or Apple. So why don't we look at that on Monday for Frederick?
Okay, sounds good.
Awesome, Dave. Well, thanks so much.
Thanks, everyone, for joining. Stay safe out there. Have a great trading day, and we hope to see you guys on Monday.
Trade in peace, chameleons. We will see you Monday. Have a great trading day today, tomorrow, and have a great weekend.